So Theo, I think today we need to talk about growth assets. We always, when we try and create a portfolio for clients, we try to understand what should be put in that portfolio to make sure that our clients can get capital growth that grows faster than the inflation rate. So if we look at what growth assets are, and especially in our lives, what's an easy way to buy growth assets, typically they're going to be things like shares in companies. So you could either buy a private share or you could buy a share in a stock market company, or a company listed on the stock exchange, commercial property, and nowadays you can even buy those on the stock exchange as well. But you need something that's going to generate you capital growth, and you're going to need something that's going to get you an income stream that grows faster than inflation. And I think typically if you go over long periods of time, the two ones that we've liked in our lives are going to be shares and commercial property. So how do these things perform, and how do they compare to other types of assets?
Warren, every year Credit Suisse produces what they call the Yearbook. This has been going statistically wise from 1900 to 2018 is the newest one. That's a 117-year period. The research is done by the London School of Economics. Now what they did this year, which is different from other years, they looked at growth assets, which is equities. That's the easy one. They looked at that, and they took the annual performance for the last 117 years. But then they used alternative assets as well. And in the alternative assets is art, wine, stamps, violence, gold, diamonds. And they looked at the annual return of these assets. Now these other assets are not necessarily growth assets. They don't produce a dividend, they don't pay you interest, they don't pay you rent, and you cannot sell them by piecemeal. You can't cut a piece of your painting off if you need income. So the question is, how does these assets perform? And if you look at the long-term average growth per annum, they in most cases less than half of the real growth you get from a growth asset. Which means if you add this over long periods of time in things like art, wine, violence, you're going to get less than half of what equities produces. But the other point is you cannot sell portions of it. You can't sell one string of your violin. So I think one needs to be careful. The performance is not there as a collective. And secondly, they cannot produce income on a continuous basis. And that's part of the definition of a growth asset. A question that we get more and more is the biggest single stock in our universe, either the all-share index or the top 40 or the top 20 index in some of the funds, is Naspers. Naspers currently is between 20 and 25% of the index, depending how you look at it and depending how you measure it. But the point is, it is a very big portion of our index. What does that mean, and does it change your view on index investing?
So if we look at index investing at the moment, one of the big criticisms that you get of index investing from asset managers particularly is this whole question that you've raised about the size of Naspers, and it now represents such a huge part of the index, and it's going to, if it drops, it's going to have a devastating effect on investors' long-term returns. And there is merit in that argument. There is a point to what they're saying. However, I don't think it's so devastating as they would say. If we were to jump back 10 years ago and we were to look at the top 40 index, two mining companies made up more than 35% of the index. That's two companies representing, that's a huge proportion of your capital. And if we look at those two mining companies today, 10 years later, they represent less than 5% in combination. So they've gone from this massive gorilla that was moving the whole market in a direction to nothing. It's a little mouse that just participates in the market growth. The nature of the index will always change. What makes up the index will always go from mining to industrials to let's say now tech companies, etc., etc. And the fashions will change, but it doesn't change the value of the index. Because the point is, long-term returns are driven by the growth of those underlying companies in the index, but also the cost of your investments. And the combination of low costs and the most efficient companies in an index is what really gives you the long-term returns. So yes, I think Naspers is a concern, and yes, it's something we should monitor, but that's not a reason to avoid index investing. You do find that this happens from time to time, and really it's not such a big issue that the fund managers are making out of it today. So I think in summary, Theo, we need to just say, it's important to have exposure to growth assets in all stages of the market. So it is important to be in the stock market. If you do it via index investing and you're listening to all these commentators worrying about the value of Naspers, don't worry about it so much. But the one big way that you can actually prevent Naspers impacting your portfolio too much is proper rational diversification. In other words, you need an exposure to cash, bonds, property and shares, and you need an exposure between the local markets and the international markets. And I think for now, we feel very strongly that the rand is an extremely good value at the moment. And when it's trading below 12 rand to the dollar, if you don't have sufficient offshore allocation, then you need to use this opportunity now to get your offshore allocation correct. If you don't know what that means, if you don't know how much you should have overseas, please speak to your advisor, because now is the time to take advantage of a sale which is happening on the rand at the moment. The rand is really good, it's time to take advantage, but that doesn't mean you take everything from local markets and put it all overseas. We're certainly not saying that. You just need to have a rational diversification and make sure that it's correct now.